Hi, my name is Alex Fensky, and I'm the lead agent for the Chicago Southland Homes team here at Keller Williams Elite. And just wanted to go through a big update on what's going on in the market and why it is this way and what's going to happen next. A lot of what's going on and what has taken place in the real estate market since COVID began impacting it is really not what anyone expected. And it's kind of counterintuitive, and I'm getting a lot of questions about it, having a lot of conversations about it, and just thought it'd be a good opportunity to help everybody see exactly what's going on, why, and where we are probably headed. So here's what we'll talk about today. We're going to go over, cover quickly. We're not going to spend too much time on what we thought would happen, but it's important to acknowledge just because of what was unexpected. We'll talk about what we thought was going to happen, and then what actually transpired over the last year. And then we will go into what will happen next and what opportunities that may mean for buyers, sellers, and investors. So that's kind of what we're going to go through here, and we'll get it going. Number one, what did we think was going to happen? Think back. Today's in April here in 2021. A year ago, everything was shut down. I think at this point, schools were supposed to have been reopened already because they'd been closed for 2 weeks. Offices were closed. Chances are wherever you work, it was, the office was closed. Nobody knew what was going on. You couldn't get toilet paper. Streets were deserted. It was very eerie. I remember driving home from the office the day that we decided to close the office, and just things were quiet, and there was like helicopters and flying around. I'm not really sure why. Everything was called off the radio broadcast, and everything was news conferences. It was just very strange and eerie. And of course, you can't forget this: no toilet paper. So when that happened, we were preparing for the worst. And GDP dropped 31.4%. That had never, ever happened before. And that was in the first quarter. That was just in the second half of March. Nothing like that had ever happened. Totally unprecedented. And we were really buckling up for a rough ride. We got together and decided to slash expenses, prepay rent with the cash on hand. I mean, we were really expecting the worst. We were expecting that whenever the economy reopened, and we really didn't know at that time when that would be, but whenever it reopened, we thought that there'd be a short period, 2 to 4 weeks or so, give or take, that would be pent up demand in the real estate market for people that were in the middle of the process that really had to get moved. And then after that, in it for a rough ride. The market at that point had been increasing since the beginning of 2013, a full 8 years, and it already started to level off and soften a bit. So it really looked like a full market cycle, and we really thought that this was just the trigger event that was going to cause a market correction. And that, there would be a lot of foreclosures and distressed sales, and, not that it was going to be just like the housing crisis of 08, but definitely a tough time. And we were prepared for tough times. Here's a couple of charts that show exactly what we thought would happen. Now, this one here on the left, that's like an L-shaped recovery, meaning everything drops out. This is actually a graph from Japan in the 1990s. So everything drops out, and then it's pretty flat and slow. Like, it takes a long time to recover. That was one thing that we thought was a possible outcome. Another one was a potential W-shaped recovery, where the bottom drops out, you get going again. In this case, this graphic was specific to COVID, but then a second round of closures would cause another sharp decrease before we eventually did get back to normal. And in all these cases, they said, probably 3 years before anything looked like it had previously, because of the 31.4% drop in GDP. And so we were running all of our training around shifting markets, around slashing expenses, around getting lean, around distressed sales. And then it never happened. That 2 to 4 week bump, which began kind of right around Memorial Day, it never stopped. So let's talk a little bit about what actually happened. everyone was wrong. And nobody that I ever heard, nobody ever predicted what has actually happened since then. We had our dead patch at the end of March and for basically all of April, as we figured out what was allowed, were we essential or not? How are we going to bring people into other people's homes when nobody's supposed to be around each other? How do we do video tours for all of our listings? There was a lot that we had to figure out, and we spent, I would say, all of April doing that. And then in May, we'd kind of figured some things out. Showings were resuming again. Although they were coming back from a place of being down by 40, 50%. And so that dead patch was second half of March and most of April, pretty much all April. And then we began to climb back up. And it was Memorial Day weekend that for the first time since the interruption, the pace of showings, the number of showings on homes actually exceeded the same week of the prior year, 2019. And so that's where we said, all right, here's the bump. Let's get it while we can, make the most of it, and hunker down. So we go through June. It doesn't slow. We go through July. It doesn't slow. All the while we're thinking this is going to end any minute. Like any day, the showings are going to stop. We won't have any advance notice. And it's just going to be like, all right, party's over. Time to hunker down, buckle up. It's going to be a long ride. All the things we've been talking about with cutting expenses and getting lean and all of that. Yeah, but it never came. So here's what happened is a K-shaped recovery, meaning some portions of the economy are doing well and others are doing poorly. So we're going to break down what exactly that means for real estate. Here's a breakdown of the sectors of employment and how they fared through that time period. Now you can see that down here that the financial services sector had even like in December 2020, you've got in August 2020. August 2020, unemployment was 4.2%. That's really crazy low. So you can see here that these categories on the left, professional services, business services, wholesale trade, construction, all did fairly well, even at the worst. Manufacturing did well. Transportation did not do well at first. But everything to the left of that hung on. These were not the hard hit industries. And some of them actually did, as we mentioned with finance, very well. Here's the funny thing is all these categories on the left, these are the people that buy homes. The categories on the right that were the hardest hit, leisure and hospitality, retail, there aren't a whole lot of home buyers that come from these categories. Your retail store clerk and your cashiers and your waitresses and waiters and things at restaurants, they don't make enough money to buy homes in any market, unless maybe they have another household member that's the breadwinner or something like that. But those incomes are not alone enough to buy homes, and most of those people don't buy homes. And so what happened with employment was that the people that typically buy homes were now in still pretty good shape to buy homes. The people that don't usually buy homes were the hardest hit, but they weren't buying homes anyway. And that's the bottom leg of the K, and why that the sector of employment determined a portion of the strong housing market. The next is age. So when you take a look at age, you can see here that the unemployment rates for people that were 35 and up, not bad. I mean, right now it stands at 5.3%, and it's remained fairly low, even going back. And at the same time, that age group accounts for 74% of home purchases. It's worth noting that according to the most recent data from the National Association of Realtors, the median age of a first-time home buyer right now, 34 years old. Well, 25 to 34-year-olds are only buying a little less than a quarter of the number of homes anyway. And I would guess that a large portion of that is towards the top half of that age bracket, not the bottom half, especially when considering that those 24 and younger hardly buy any homes at all. So you've got people that are of home buying age doing pretty well, actually doing really well. And people that are not of home buying age are the ones that, again, are hardest hit. So that has a lot to do with the strength of what's happened in the market as well. Now, one other element of the age factor here is the echo boom. The baby boom was the biggest generation. Obviously, all the people that were born post World War II in that decade or so, a couple of decades where the economy was booming, everybody was partying, it was a good time, having babies. Then that huge population obviously had babies when they came of age, and that was the echo boom. And now the echo boom, you can see it in the curve, right? Here's the baby boom. That's a spike. These percentages don't look all that different, but when you talk about 331 million people, it's a big difference. So here's the baby boom right here. And then right here's the echo boom. And you can see very, very disproportionately high percentage of our population is in this category right here. And so not only are people that are of typical home buying age, 34 and up, not only are they already more gainfully employed, but there's way, way, way more of them. There's way more people that are that age. The echo boomers have come of age to buy homes. And so that's put additional pressure on the market because they're buying, but they don't have anything to sell. They're first-time buyers. So they're adding a bunch of buyer demand and they're not increasing the level of supply at all. So the echo boom makes that age element of the K-shaped recovery even more exaggerated. The next factor that's contributed to where we're at right now is mortgage interest rates. Now, one thing I want to clarify is that mortgage rates don't typically directly drive home buying activity. They're like fuel to the flame, though. People don't up and decide to buy a home because rates are low. First-time buyers, it helps a little bit more, but they don't just go, rates are low, let's buy. That does happen with refinances, because with a refinance, all you're doing is you're buying the money. It's just about the money. It's nothing else. So when the money gets cheaper, you exchange the money. But people buy and sell homes because of household formation, because of job transfer, because of marriage, death, divorce, birth. I mean, these are the reasons that people buy and sell homes. And mortgage interest rates just add fuel to it, meaning rates go down, it allows someone to pay more for a home, or maybe get someone over the edge from, I'm not sure if I can buy, to yes, I can buy. But as you can see here, interest rates hit all-time lows. That happened, they hit all-time lows in April, and then they kept going down from there. Now they've come up a little bit, and then in the last week or two, back down a little. But suffice to say, there were never numbers like this seen previously. So mortgage rates have definitely added fuel to the fire here. This is something that if you look over the historical context, 7-8% was the average over a long-term period. But if you take a look at the average in the most recent 30 years, it actually has been lower. So a lot of us are not sure whether rates ever will return to numbers like 7 or 8%. But as far as why this happened, this wasn't because the Federal Reserve dictated it. The Federal Reserve doesn't determine mortgage rates. They determine the federal funds target rate, which is the rate that banks can borrow money overnight, short-term borrowing rate. It has an indirect effect on mortgage rates, but here's what determines mortgage rates. The going rate for 10-year treasury notes. Here's why, and this is relevant. When the economy is expected to do poorly, investors flock to safe and secure investments, and there are none more safe or secure than United States Treasury bonds, because they're guaranteed by the government. So when everybody flocks to that investment, it pushes the prices of those investments up, which pushes their yields down, meaning investors are willing to pay more and accept a lower return simply for having the safety of saying, yes, my money's in T-bills. And mortgage-backed securities, which is what are created when mortgages are written and then the money is sold on the investment market, Mortgage-backed securities are another secure investment that competes with the 10-year Treasury note. And so when Treasury notes become more popular and the yields go down, mortgage rates have to go down in order for those secondary market buyers to buy up the mortgage money after it's written. If I just lost you there, sorry, I do like to nerd out on that a little bit. Point being, confidence in the economy has a big effect on mortgage rates. And so when everything bottomed out and everyone freaked out, everyone flocked to T-bills, mortgage rates went down, and the Federal Reserve started buying bonds themselves as well, which is one of the things that they do when the economy gets scary. So all of that contributed to crazy low, record low mortgage rates, and that added fuel to the fire of more buyer activity. The next factor here is kind of a sleeper. It's not one you'd expect. It's new home construction and the fact that there's been a dearth of new homes built. Very, very big gap in the number of new homes that normally would have been built in the last decade or so that didn't get built. Why? Because in 2008, builders got hit the hardest. Tons of them went out of business. The ones that stayed in business couldn't build many homes. They didn't need to build many homes. There were way too many homes available for sale already. So the pace of new construction slipped. Now, the long-term average is about 1 million a year. And over time, that's pretty consistent. But after 08, or starting in 08 rather, you drop down to a little more than half that and then below half that. It's been a long climb back up in 2020. We just hit that million again, which is great for right now. But in the meantime, there's a big gap here. In this time period of 12 years, about 12 million homes should have been built, but only 7.9 million were. So you have over 4 million homes that never got built that now are needed. Now, for context, every year between about 5 million and 5.5 million homes are sold overall, not just new construction, 5 to 5.5 million. So 4.1 million new homes that never got built. That's like almost a year's worth of home sales where the houses just aren't there. They don't exist. So this is an issue that will take years to correct for them to catch back up. Now, I can tell you, I was going to conferences 5 years ago. They were predicting this. They said this is going to happen. Builders have not kept pace, and there's going to be a supply. And sure enough, here we are. This is another thing that then has put more pressure on the existing home market because the new homes that people would have wanted to buy right now, especially with that echo boom, they're not there. So that's another factor. Now, the last factor we'll go into here is a shift in demand. And I don't just mean a shift in the quantity of homes wanted. I mean a shift in what people need from a home. Suddenly, everybody was at home 24/7, and that's never happened. So they needed to work from home. They needed a home office. Their kids were going to go to school from home. They needed an e-learning area. I don't know if you ever tried to have those two areas be the same area. It doesn't work out real well. They wanted backyard space more than ever, because if we're going to be here at home and all the stuff we like to do is closed, we need to do activities, whether you have kids or not. I mean, you need more space. Pools were in crazy high demand. They still are. It's still today. You're looking over a year out to book for an in-ground pool because they're so backed up. So there's been a real huge shift in what people need out of a home. Now, on the flip side, the opposite has happened in downtown urban condo markets because all the reasons that people normally live there got undone. Think about it. Why do people live in downtown Chicago? Well, they live there, number one, to be close to work. They either want to walk to work or take the L to work. Well, work isn't open. You're working from home. So scratch that off the list. They live downtown to be close to the restaurants and nightlife. They're all closed. You live downtown to be close to the big events that happen throughout the summer and the different things that they're not happening. They're canceled. All the amenities, everything that people like to do downtown isn't there. And throughout the summer of 2020, there were a lot of protests that damaged property and what have you throughout the River North and Loop areas, and so there a lot of buildings were boarded up on top of all the housing issues, that just made the area even more or even less appealing, I should say. And on top of all that, you don't have a yard. You're trapped in like an 800 square foot box, nothing to do. And it caused a lot of people to list those condos and move out towards suburban or rural single family detached homes. So the urban condo market has not performed the same as what we're talking. It's in many ways it's the opposite. But this demand shift caused a huge fluctuation in the type of housing that people were buying, and it concentrated it on the detached single family homes. So, with all that, what's happened? What did all that do to the market? Well, take a look at housing inventory. This is the number of homes available. You can see that, so that the orange bars or the yellow bars are 2019. You can see that in 2020, the number of homes went up because buyer activity had frozen, but then way down, and now down to record low levels. In fact, if you take a look here at the months of supply, I'll explain what months of supply is. It takes into account the number of sellers and the number of buyers. So months of supply measures how many homes are on the market, inventory, and then on the other hand, it measures how many homes are buyers currently buying each month. And so theoretically, at that pace of sales, which we call the absorption rate, at this absorption rate, how long would it take to buy up all of the existing inventory? We divide that, take number of homes available divided by the absorption rate, number of sellers divided by number of buyers each month, and that gives us a number of months. 6 months of supply is historically considered to be a balanced market. It's not a buyer's market. It's not a seller's market. At that rate, the prices of homes are only going up according with inflation. It's very level. Now, if you have more than 6 months of supply, that's a buyer's market. That means that there aren't a whole lot of buyers buying homes in relation to the number of homes available. And so you can see here in this graphic, at the end of 2006, and then certainly through the crash, there was way, way too much supply in the market. And this is what causes prices to go down. These numbers actually aren't even the worst. I remember looking at market reports for my local market area and seeing numbers like 34 or 36 months of supply. It got really bad. Now, here you're seeing that nationwide, you're looking at 3.1 months of supply. I can tell you that at a local or at least a regional level in our multiple listing service, the Northeastern Illinois area, total number of homes for sale is down about 54.5%. And for detached homes, it's down 67.3%. So that means that go back to early March last year when things were still normal. COVID hadn't hit yet, really. Normal amount of inventory. If there were 10 homes on the market then, there's only 3 right now. And that doesn't even compare at all to what happened in, for example, 2008. But this is why prices are rising, because we are down now to 1 month of housing supply for detached single family homes in our multiple listing service. 1 month. That means that every month, the number of homes available right now, that's the number of homes that's going to sell. So you could be turning over every home for sale every single month. That causes prices to increase, because when there aren't enough homes available for the buyers that need them, buyers compete for those homes, and they compete primarily with price. Let's offer more, offer more, offer more. So what happens? This happens. You get prices that rise dramatically. This is the median home value just over the course of a year. You can see how much it came up. And this is nationwide, but the same can be found in many local areas, including many here. So with that, you know for sure that prices have gone up quite a bit. Now, we'll talk later about what we expect to happen in the future. But you can see that in kind of a strange correction, prices got out of control here during the boom before the Great Recession. They dropped below the long-term trend line. And we actually, for a time, thought we may never go back to that trend line. But this is actually pushing the long-term home price appreciation rate back to the long-term trend line. So you can see that the big jumps there in prices, and that is because of supply being low, which is because of all those factors that we talked about that led to this: the K-shaped recovery, the echo boom, interest rates, so on and so forth. So what does all that mean for affordability? Now, affordability, this is an index that's compiled that takes into account prices, mortgage rates, and household income. And what they look at is what is the proportion of typical median household income that it takes to have a typical median mortgage payment based on the rates and the prices of homes for any given moment. And there's regional data for affordability index, and this is national data. But you can see it's actually pretty low in comparison to where it's been. I mean, back before the crash that began in 06, the affordability of homes was less. They were less affordable. So a higher dollar amount here or a higher affordability index means homes are taking up a larger percentage of the household budget. Back here, this was because interest rates were like 18%. But even in 2020, affordability still stayed pretty low. That will change as prices and rates continue to go up. So with that said, that's everything that's happened till now. All of those factors have left us with record low homes for sale, and high demand, low supply, low interest rates, a lot of buyers, not a lot of sellers, and an environment of increasing prices. So let's talk now about what's going to happen next, because everything I just said probably makes a lot of people go, oh, well, this is a bubble, right? And a bubble always bursts. So when is it going to crash? That's what a lot of people are thinking. So I want to address that. We just looked at that affordability slide, and you can see that affordability was way different in the real estate bubble that was leading up to 05 and then to 06. At that time, that was driven by speculation. It was not driven by real market forces like the ones that we just discussed that are driving these changes today. That was driven by people buying homes and sitting on them for 6 months so they could sell them 6 months later. That was driven by people getting mortgages that financially were not in a position where they could actually afford the mortgages. That was caused by mortgages being written that were time bombs, that were basically a guarantee of foreclosure because of what was happening with the terms of the loan sometime after it was written. So that was all speculation that drove that, the real estate crash then. Everything we just talked about, there's nothing speculative about it. People want something different in homes these days. Money is still cheap. You still need a down payment. You need a better credit score. They're not going to give you 100% financing like they used to do. You still need to be credit worthy. So none of that stuff is going on. And there just isn't speculation happening. It's based on a true shift in demand. So unless something changes, we're not expecting a crash after this. It will soften. 1 month of housing supply is not sustainable. It won't keep going at that. So let's talk about what's going to happen from here based on everything that we know now. And by the way, I should give a disclaimer. A lot of what I'm about to say, almost all of it, is not stuff I made up. I didn't just sit here and go, here's what I think, and rub my crystal ball. This is all from data, research, and from a lot of people that are a lot smarter and a lot more educated on these things and are studying this at the macro level, and people that have been through a lot of cycles in housing and economic markets. So this is not just me making stuff up. That's good, right? So here are the bullet points here. The K-shaped recovery in terms of employment sectors, and in terms of age, and who's doing well and who's buying homes, that's going to keep going. We don't expect that to change at all. Unemployment is actually down to 6% overall. And again, those other employment sectors and those other age groups are performing better than that. So 6% is not bad. It's higher than we want long term, and it's 2.5% higher than what it was before COVID. But it's okay. It's okay, and it's going to be years before that echo boom moves through and buys all the homes that they need to buy to start families and things like that. So the K-shaped recovery is going to continue. It's not going to change anytime soon. Interest rates will rise eventually. I mean, we're looking at them going up by maybe a full point in the next year. So it is going to impact affordability, but we're not looking at rates going up to 6 next year. It's just not going to happen. So that'll change, but gradually. New construction takes a long time. First, you have to buy land. That process in and of itself takes a while. Then you have to develop it. It usually takes 1 to 2 years, depending on what they're developing. But they have to engineer and regrade the property. They've got to install roads, install the utilities, plan the communities and everything. It takes a lot of time and a lot of money. And then they can start building homes, which, by the way, takes 6 to 9 months to build the homes. So builders can't just turn on a dime and change their pace of production in terms of increasing it. So that's going to take a while. It's going to take 2-3 years for them to catch up with the homes that they would have needed to build in order to prevent a supply shortage. Then government aid. So we didn't really talk much about this. It has had an effect on the market, but not as much of an effect as these other factors. Aid packages of unprecedented size have been passed starting in last spring and continuing up until just recently. And they've been very needed. And at the same time, they are artificial in the sense that they'll end, and they're propping things up, and they're helping some of the hardest hit people and businesses. But that will end. And some of the things that we're talking about are the SBA disaster relief loans, the payroll protection program that's now in its second round, the economic stimulus payments, aka stimmies. You've got the Federal Reserve actions, keeping interest rates low, buying bonds, doing the things that they've done. You have some housing specific government aid programs like the federal loan forbearance programs, bans on foreclosures and evictions, and lots of things like that. So probably somewhat soon, but that stuff is going to end and at minimum scale back. In relation to those housing items completely, June 30th is the current expiration date for the federal foreclosure moratorium, meaning any foreclosures on properties that are encumbered with federally backed mortgages, as well as that's the deadline for forbearance enrollment for people to get into a forbearance program. So June 30th is the current deadline for that. And then in Illinois, the eviction moratorium ends on May 31st. Now, both of those dates have continued to be pushed back and extended. So those might not be the final dates, but they will end at some point. And as things overall improve with vaccination programs and things like that, it's going to be sooner rather than later. In the meantime, think about what will happen when those programs end. 1 in 5 renters right now nationwide is behind on rent, 20%. At the same time, there's 10 million homeowners that are behind on their mortgages. Now, remember when I told you that on average, every year, 5 to 5.5 million homes are sold. There's double that in delinquent mortgages right now. That's a huge number. And some of those people will get caught up. Some of them will end up selling a home that they have equity in because of what's happened with prices. Some of them will eventually foreclose. But a year ago, we thought that there would be a lot of foreclosures, and even by now. And now that's going to happen, but it's going to be so far out, and the effect is going to be spread out, and those homeowners still have equity to avoid foreclosure. Take a look at this. Foreclosures normally take about 6 to 12 months. In Illinois, we have what's called a judicial process, meaning the bank doesn't own the property. They have to sue the homeowner in order to take the house from them. So it's a court process. It's not that way in every state. That's for judicial states. And that's a 6 to 12 month process in normal times. But whenever this resumes, courts are starting from scratch. All of the foreclosure cases that were pending in March of 2020 got wiped from the slate. They're off the docket. They're going to have to be restarted. And then it'll end up being probably a year and a half worth of foreclosures that never got filed, that the banks are going to have to file. And not only that, but there's actually more of them than there normally would be, because there's 10 million people that are behind on their mortgages because of all the economic problems from COVID. So take all those factors and add it up and go, okay, the courts are now open for foreclosures. It's going to take them years just to get a foreclosure done because of the backlog, and probably 2 to 3 years for them to get fully caught up on that. And then lastly, we're looking at affordability again. Here's where I'm going to give you my personal opinion. I think affordability overall is what's going to tamp down or slow down the pace of growth that we're seeing right now in terms of prices, and get some of the extra buyers out of the market and relieve the pressure on the housing supply. I think that's what's going to happen first. Prices going up, rates going up. I'm going to show you some numbers on that shortly that show how that impacts a buyer. And when that keeps going after a while, those numbers will hit levels where more buyers start to opt out, and they just start to say, you know what, I'm not going to buy a home at that price, or I can't buy a home at that price. And they decide to continue renting or to stay in the home that they currently own, or whatever. Median prices of detached single family homes in our entire MLS are up 11.3% on a rolling 12-month basis. They're up 17.6% March over March. So that's a big increase, and that doesn't continue. That's not sustainable. And some areas are even a lot higher than that. That's an overall average for our region. So things have come up quite a lot, and we don't expect them to change soon. In fact, in the next year, we're expecting that home sales will actually increase nationwide, nearly a 5% increase in the number of homes sold, a 7% overall increase in median prices of homes, and pretty much flat housing supply. But again, remember, this is different everywhere, and depending on what type of property. I just told you it's 1 month of supply for detached homes in our multiple listing service. So we expect that to continue. So based on that, I just wanted to, for overall context, I talked earlier about how the market had been rising since 2013, and it looked like we were probably, you see right here, 2019, things flattened out. And in early 2020, we were thinking, hey, this might be when we start to head back down again. That's a full market cycle. And then zoop, they went up. So here's what I want to caution you against. I want to caution you against waiting until you think the market's going to crash. I saw this. I thought this was hilarious. If you don't know football, that's Tom Brady. And the guy's been in the league. Every time you think he's going to retire, he's too old, he comes back and wins more Super Bowls. So it's kind of like that. If you've been waiting for the market to crash for the last 5 years, you're going to keep waiting. We don't expect that the market's going to crash. It'll slow. It'll slow and it'll return to normal conditions, or at least towards that, but it's going to be a while. So what does this mean for you? What are the opportunities? We'll talk about buyers, sellers, and then investors. So when you're talking about buyers, prices going up in the future means it's better to buy when? Now or in the future? Well, it's better to buy now. Interest rates, same deal. They're going to go up. So would you rather buy when rates are lower or higher? The catch is, and the trick is, it's still tough right now because there's not a lot available. You're going to have to offer over list price. You're going to have to really pull out all the stops to get a home right now, but it's actually still going to leave you better off than what you would be buying a year from now. And I'm going to show you a chart on that. So just buy what you can now, get in the door. It's not going to be your last home if it's your first home. Just buy as long as you plan on staying for several years, locking in low mortgage rates. It doesn't make you money tomorrow, but over the course of time, your principal on your balance will pay down pretty quickly with a low mortgage rate, and you'll lock in the savings and build some equity over the next market cycle. Here's what happens when mortgage rates rise. If you take a $200,000 loan today at 3.25%, which is about the going rate today, the principal and interest on that loan over 30 years is $870. At 3.5%, it's $898. and so on and so forth. Now, remember, I said we're projecting about a 1% increase in mortgage rates over the next year. So the same amount of money borrowed at 1 point higher will cost you $114 more a year from now. So we talked about affordability. That's kind of a big deal. $300,000 and $400,000 mortgages, the increase is, it's about 14% increase in your mortgage payment, from 1306 to 1476, from 1741 to 1968. That's about a $220, $230 a month difference from mortgage rates alone. But as we talked about, prices are going to be going up too because of low supply. So when we think about prices going up, $200,000 today, which is costing you $870 a month, in a year, it's going to cost you $916, even if you kept the mortgage rate the same, right? So this table this is all locked in at 3.25% mortgage interest on the mortgage. This is only looking at price increase and what that does to your payment. On a $400,000 house, after the price has gone up on a home 7% more, $1,832. So you're adding about $90 a month there. But as we just have discussed, and sorry to beat the dead horse, but it's both that are going to go up, prices and rates. And here's what that looks like. That $200,000 loan today that costs you $870, in 12 months, it's going to cost you $1,005. In 15 months, $1,053, 18 months, $1,102. So, in a year and a half, buying that same home that you could get for this price today, it's going to cost you $232 a month more. So you could either buy that home now or buy it a year and a half from now and let the seller capture all that appreciation and the bank capture all that interest income from you. For a $400,000 house that would cost you $1,741, you're looking at 12 months from now, that's going to be over $2,000 a month. These numbers start to get bigger on a bigger loan. You see, you're already here approaching $300 a month in an additional mortgage payment. So as a buyer, it benefits you to lock in money now. And I'm not just telling you this, I'm buying right now too. Now I'm selling as well. So we're gonna talk about that. But locking in today's prices and rates is going to help you build wealth over the long term and help you get something that's affordable. I can tell you right now, people that were looking at homes 9-10 months ago that thought it was tough then, right now it's even tougher. And they're looking back at that going, man, I should have just bought something. I should have just gone crazy over list price like I would have needed to do. I just should have done it because I actually would have been better off. We can't change the past, but you can use this information and make the best decision for you now. Now let's talk about sellers. Well, sell high and buy low. What do I mean by that? Well, prices have come up quite a bit. And there's lots of people that can sell homes that they wanted to sell before and they couldn't because they were underwater or there wasn't enough equity. You can sell and you're selling at a great point. Now, when I say buy low, what I mean is that you're buying a low rate. Just like the buyer side that we just talked about, if you wait another year, you're going to pay a lot more interest and your payment's going to be higher on whatever you buy, in addition to it costing more. So if you're going to make the move, it may be best for you to make the move now to sell at a great price and lock in interest rates that are lower than what they'll be in the future. You can sell high and rent, meaning maybe you're done with home ownership, or maybe you're going to relocate to a different state and you're not looking to buy right now. Well, that's actually the best because it is tough on the buy side. So sell now, call the shots on the terms, get the best price, and then go and rent somewhere. Selling high and buying up can be a good strategy as well. Now, this works if you're buying a home into a higher price point. And that might mean because you're relocating into a different area, or you want more house, or you just want nicer house or whatever. But the inventory shortages and the low supply does not exist in that same way at higher price points. The lower the price point, the more demand there is because there's more people that can afford those homes. But as you start to get up to double the median price point for an area, there's usually about double the amount of housing supply. So if you sell a home that's somewhat in the median or maybe even below the median value, and you buy a higher priced home and you buy up, that's a pretty good move to make. You can just create your ideal sale terms. I mean, if you want to rent back for free after closing, or you want to make sure you get a cash offer, or you want to close on this particular date, or whatever you want, as a seller, you've got leverage in the current market. So it is a great time to sell a home. And even though it's challenging when you go to buy, there are some good moves to make, and there are some ways to make that happen. There are also a lot of things that a great agent can do to help you with strategies and tactics when it comes time to offer. So be sure that you're working with a great agent, and that'll help you on the buy side as well. Now, investors aren't totally different. They're sellers and buyers too. So everything that we just said also applies. But I'll tell you, there's never been a better time to sell a rental property that is either mediocre performer, meaning you don't have a lot of cash flow, or you just never wanted a rental property. Maybe it was an accidental rental, and you only rented it out because the value wasn't there to sell it, and you had to move. Well, now you can sell it. We've sold a ton of accidental rental properties, including one of my own. Actually, I never had an accidental rental. All of mine were on purpose, but sold an unwanted rental. And I'm in the process of selling a couple of other rental properties that are basically my worst performers. I have a lot of equity in them now, and I'm going to take that cash and go buy other investments that are going to make more money instead of the amount of money that the mediocre properties are making now. It's also a fantastic time to refinance debt. Even as an investor, depending on your credit score and everything, I mean, you could get a 30-year fixed rate investment mortgage for under 4% right now. There's never been another time for that. So it's a great time to refinance debt. And it's also a good time to take on debt. Now, don't get me wrong. I'm not saying everybody go out and bury yourself in debt, but as an investor, debt is good to take on if it's associated with high returns. And so it may be a good time to increase debt, meaning maybe I'm going to sell a property with a mortgage of this size and go buy up into a bigger property because the new mortgage is not going to cost me much interest and I can get into that new property. So it's a good time to increase debt. And also, if you're going to trade up, you may consider using a 1031 exchange. That's something where you're going to defer any capital gain from the appreciation you've had in an investment property and roll that into the next one and delay some of the income tax implications. So that can be a really good thing to do now. Again, especially moving from a median price point to a higher price point, which is what a 1031 is. And lastly, vacation rental properties. There's been a tremendous increase in demand for drive-to locations in the COVID era because of the lack of plane travel. So because people aren't doing air travel, they still want to get out of the house, and they a lot of times can't stay in a hotel or won't. So they're staying in Airbnb, VRBO, vacation rental properties. So that's something that is a good opportunity for investors right now as well. So those are all fantastic things that we can do. Any questions that you have, I want you to send them over. If you have specifics about your scenario, you want to tell me about your needs and plans, or if you have other people that you want us to talk with, you can send me an email, alex@chicagosouthendhomes.com. You can call or text me on my cell phone. And that's an easy one to remember. It's 708-508-ALEX. I had that one since I was 16. You can visit our Facebook page, facebook.com/Chicago South End Homes. You can also download our app, our mobile app. We'll show you properties at the neighborhood level anywhere in North America. You can create collections and save and share properties. You can get instant notifications or not. And you can search by school district. There's a lot of good features with that. So you can download that at tinyurl.com/CSH mobile. Last little shameless plug is that we are hiring, in particular right now, we're looking for agents. We are busy, and there's more opportunity for us to serve more people. So if that's something that you're curious about, feel free to give me a call or contact me through any of these channels that we've put here. I appreciate your time. Thank you for listening. I hope this was valuable, and definitely call me for anything that I can do to help you out with so you can make some good real estate decisions in the next 2 to 3 years. Thanks a lot.